says recording up there in the left-hand corner.
Yep, okay, you're good now.
All right.
So again, David, I'm going to turn it over to you. Thank you so much. Everybody, thank you for attending this morning, and be safe and be healthy.
All right, Judy, thank you. Thank you so much. So as she said, my name is David Boothe. I'm President Financial Advisor at BIG Investment Services. We're a full-service financial advisory in Dover, Delaware, with clients all across the country. You can read all about us at abigplan.com. You can listen to our podcasts, each week. Comes out on Saturday to kind of keep up to speed with things. So Judy asked me if I would give an economic forecast for 2020, a post-COVID forecast. So we'll be glad to talk to you a little bit about that today. I think the best way to do that, the best way to talk about what to expect going forward, is to actually take a couple of steps back and revisit where we've been. The title of the event today was Post-COVID Economic Forecast, and I think one of the big questions.
It sounds like that's coming from Gina Sacchetti's. That's what lights up when we're hearing that noise. So I don't know if there's a child there or not.
I think they just muted themselves.
Oh, good.
I'm sorry.
No worries.
Okay.
All right. So anyway, in order to get a good handle on what to expect going forward, I think we need to take a step back, because the title is Post-COVID Economic Forecast. Well, I would pose a question: are we actually post-COVID? And I would say, no, we're not fully post-COVID. So let's talk a little bit about that. Let's take a step back. Going into 2020, and if you listen to our podcast or follow us at all, you know that we were expecting a pretty stellar year for the economy and the markets. And the reason why was that the economy's been really flat. The markets have been really flat for 2 years now, as we were dealing with the China trade war. Markets just didn't go anywhere really from the fall of 2017 to the fall of 2019. And it looked as though that was finally coming to some sort of, at least, temporary resolution. And with that, expectations were that we were going to see some really strong numbers going forward into this year. Well, that's exactly what we started to see. As a matter of fact, as quarterly numbers have been coming out here recently, we've noticed that the numbers were really off to a fantastic start in the first quarter of 2020. But in the middle of January, I started getting very concerned about coronavirus, because the folks that I talk to, contacts that I have with China, were telling me how severe the lockdown was in China. Now, I admittedly wasn't expecting a major health outbreak here, but I was expecting a significant economic impact, as China has a really big influence in the global economy. So we started getting a little bit more conservative in January. The market then started to slide in February. And when we hit the end of February, the stock market itself crossed through some indicators that are big warning signs to me. They have been historically. And we got super conservative at that point in time, raised up a lot of cash, because it was a big warning sign that things would get really bad from that point. And they did. March was horrific. The markets took a big hit. They were down 35%. We've had huge contraction in economic activity in the first quarter. And I think that the second quarter is going to be worse, the quarter that we're in right now, as far as the economic activity and the contraction. And we're going to see probably things bottom out here in the second quarter. So putting all that together, we go into 2020 with things really rocking and rolling. I mean, even when we listen to the quarterly results from different corporations that have reported, things didn't really start to tail off for them until end of February going into March. And then they really went over a cliff. But there's a lot of companies that still continue to do well. You've got companies like Amazon and Walmart and Lowe's and Home Depot. All the companies that were allowed to be open and continue doing business have done exceptionally well and been exceptionally strong. Where other areas have been hit the hardest, things like travel, leisure, restaurants, things like that have not fared as well at all. So we have a tale of two economies at the moment. We also have a COVID economy. Okay, so companies like one that you're using right now, Zoom, have been fantastic. Teladoc has been fantastic. Peloton has been fantastic. The stay-at-home economy, these types of companies have been very strong. Now, what I would say is, as we move forward, I do not expect that the stay-at-home stocks are going to continue to do as well as they've done. I think you're going to see them drift back. even Zoom. Okay, it's been very popular. Stock's been very popular. You're going to see that probably drift back, Teladoc drift back, Peloton drift back, because as we get back out doing what we do, more normalcy, these services, although I think they're going to be, some of them are going to be used consistently for a much longer term going forward, we're probably still going to see some of those numbers drop off from their peak during the maximum part of the COVID outbreak. So now, as we move forward, here's the big question: what happens now? One of the folks, or things that folks are asking me a lot about, is what's going on with the stock market? How is it up so high when things are admittedly so bad? Well, understand that the stock market is a forward-looking mechanism. The market is not looking at the second quarter. If it was, it would be down 50% right now, because the second quarter is going to be horrendous. The market's looking right now at 2021. It's not even looking at 2020. It's looking at 2021, and it's building in expectations for 2021. And that's why we're seeing the markets respond so positively. A lot of folks are in the camp that the market's going to go back down again, go back down to the lows of March. Historically, markets tend to do that sort of thing. However, this one has crossed some major hurdles, folks. It has done some things and accomplished some things that only markets that have hit a bottom tend to do. And because of that, it's been our feeling now for a few weeks that we are probably not going to be going back down to those lows. I think we may go sideways, we may drift back a little bit, but I think the market's probably firming up quite a bit. The big variable right now is going to be the fall. And because COVID is not going to be gone. I don't think that the likelihood of a vaccine being in place by the fall is very high. We've gotten some good news on vaccines. Companies like Moderna, they're really out in the lead with that. There's some real big progress being made on the vaccine front. However, trying to get that up and running, have it tested, have it produced, and everything all through 3 phases with the FDA by the fall is it's a Herculean type of accomplishment to try to pull that off. So I don't think we should be expecting that. I think by 2021, vaccines will definitely be in place, but not necessarily by this fall. So the question is, how are we going to respond to this thing? What are we going to be doing going into the fall of 2020? Now, I think that we've learned a lot as we've gone through this. I think we probably didn't prepare ourselves quite as adequately as we should have. Didn't have things in place quite the way we needed to. The lockdowns, the shutdowns have been very broad brushed and impacted many, many people. I would expect, and of course this is conjecture because we just don't know, but I would expect that the fall, we're going to see a much more targeted approach to how we handle COVID-19 outbreaks. So I would expect rolling lockdowns rather than brush shutting down the entire country. I think you're going to see a lot more mask wearing and people still continuing to go about their business. Maybe some provisions in place for those that are higher risk. But I don't think that America is going to be led back into the barn as easily as it was this past time around, because this last time around was pretty detrimental to a lot of folks. And some of these folks are going to continue to struggle. So, for example, I think when we look at the economy, I don't think we're going to have any high expectations that travel and leisure are really going to pick up any great extent anytime soon. I think the restaurant business is going to have some real severe struggles going forward. Even if they reopen, there's going to be social distancing issues in place. And if you know anything about the restaurant business, you want to try to have as many people in there as possible to maximize your profit. If you've got to cut that in half, it greatly, just drastically changes the business model. They're going to have to raise prices or something to try to still realize some sort of profit. So that could be a major issue for that industry. But other industries are going to do well. I mean, look, the economy is shut down. But I ask you this: how many people do you know? How many people do you know that aren't working? Right? A lot of folks have continued to work right through this thing. They've worked from home. They're using technology. They're doing different things. A lot of the folks that are unemployed from this are unemployed from sectors of the economy, lower wage jobs. And here's the thing. Those folks are actually getting paid some serious money right now. A lot of these folks that are unemployed are making more money than they were when they were working. Where's that going to go? It's probably going to get spent. So I think we could probably see some real big increases in consumer spending as we come out of this thing, because there's a lot of pent up demand. People have been sitting home. They've not been out. They've not been buying what they want to buy. They've held off on major purchases, et cetera. We've got another contingent of the economy that has more money coming in right now than they did when they were working, and that's accumulated. So I think we could see a pretty big increase in retail spending moving forward. And the stock market, I think, is reflecting that with some of the numbers we're seeing with some of the companies in the stock market. I think that you can see maybe a boost in automobile purchases and things like that. I think you're going to see a lot of the economy just kind of get back up and running pretty close to full speed, with certain areas that are going to stay impacted. And then the question will be, how will we handle COVID-19 in the fall? The other thing to consider or keep in mind with all of this is the amount of money that we've just printed and just dumped into the system. It's had a huge impact. The amount of money we've just created out of thin air has absolutely impacted the economy and the stock market and how we've gone through this. Now, a lot of folks will claim it as a victory because we staved off a depression, because the market has come back from its lows, et cetera. I'm not so sure. I think that it's caused a lot of moral hazards. And I think it's really changed the very nature of America at a very fundamental, basis when it comes to our economic system. Right now, I would say we look much more like a planned Chinese economy than we do a free capitalist country. There are a lot of companies out there that have made a lot of profit over the last 3 to 4 years, 4 to 5 years. They've taken that profit and they've bought back their company stock. They didn't save money. They didn't put money aside. They didn't invest it in other places or grow. They just bought back their stock to increase their shareholder value, because a lot of their executives and things get bonuses on that. Well, now these same folks are getting huge checks from the government. And sometimes you have to kind of ask yourself, where's the line here? A free market capitalist society is one where, bad actors fail and the good actors pick up the pieces and grow bigger and get stronger. So we've done a lot of damage in that regard. As a matter of fact, I would say the turning point in the stock market through all of this was when the Fed came out in March and said they're going to buy junk bonds. They came out and they said they're going to buy junk bonds. So in essence, they just gave an insurance policy on every piece of high risk debt in America. And in doing that, the market loved it. Market turned around and went sky high. You said, well, David, you're a money manager. You're a financial planner. You should be happy about that. Well, of course, on one hand, I am. On the other hand, I am concerned about the unintended consequences that are likely to come out of this going forward. And they remain to be seen, right? Where gold has been really strong lately. Is it anticipating some hyperinflation down the road? I don't know. Are we going to see more issues in the future with companies that take bigger risks and do things in a way that maybe is not very prudent? Because the government's going to not let anybody fail or struggle, then why not? I'd say as a financial advisor and a money manager, it has to change my way of thinking. I mean, if I knew the government was just going to step in full board and backstop the entire economy, then maybe we would have just gone all in March instead of mostly in March. We bought a lot more stock. We bought a lot of stock in March, but not as much as I would have if I knew the Fed was going to do what they've done. So these are all things that we have to keep in mind going forward. In a nutshell, I think that the market, the economy itself, the underlying economy is poised to grow. It wants to grow. It's not grown in 3 years, folks. So it wants to grow. There's a lot of pent up energy and demand in the market. China trade war has eased and things want to move. We can see that. The big question is, how will COVID impact things in the fall? I think it'll be more targeted. I think that hopefully more calmer heads will prevail, and we'll have a more targeted approach with COVID in the fall, and we'll mitigate it a little bit differently than we did this time. And that's pretty much what I've got. And I think going forward from there, look, we just had a recession. We're in the middle of it right now. It's probably going to end this quarter. We just had a bear market down 35%. And it's over. Okay. It has come back very strong. And I don't think it's going to go back down there. So at this point, I think that the worst is behind us. And I think we could see some strong economic activity and market activity not just for the next year or so, but for the next 3 to 5 years. I think there's some nice runway out in front of us at the moment. We'll just have to see how all that holds together. So I'm going to wrap up. I've talked a lot, very fast, a lot of information there in a short period of time, and I'll open up for questions.
David, Diane Laird here. I don't have any particular questions, but I will tell you that my husband and I are excited about retiring in September. So I know he's called you a time or two. I'm probably the nervous one, but anything particular we should think about as we head into retirement? Not me, but him in September.
Yeah, absolutely. Actually, he's been a pretty cool customer there, Diane. So he was okay. So no, going into retirement, the key there is to, well, of course, be diversified in your portfolio, in your investments, which you are. I don't think you want to be taking on any sort of crazy debt at this point in time. You want to keep that lean and mean, especially going into retirement. And those are the big things. Right now too, and of course, every situation is different. I've got to take a look to see what's there, but rates are very low. So if there's debt and things like that in the mix, it's a good time to be refinancing, lowering down interest payments, things like that. But no, I think that the key there is to be diversified, to be minimal on your debt, and retirement should come together just fine. I mean, I can tell you that as far as my practice is concerned, nobody's retirement plans were impacted. Everybody is still on target. And I think a lot of that's just being diversified and being timely, being tactical with some of the shifts and things that we've done, but nobody's been thrown off their retirement plans. So I think things are
terrific. Well, we're thankful to have you managing our investment. Thanks.
Well, it's my pleasure, Diane. Thank you. Tell Bob I said hi.
Will do.
Any other questions?
Nope, it was very good, David.
Oh, great.
David, I do have one other question. I have a friend who always says, invest in gold. That is the thing that won't change. Any top of mind on that?
That's a fantastic question. So what does gold do for you? Does it pay you a dividend? No. Does it return capital in the form of share purchases? No. The only thing gold does is it goes up in value if other people are buying it. Gold it can be a good hedge in a portfolio, especially in times of high inflation, but it doesn't produce anything. It doesn't, the only thing that makes it valuable is the fact that there's a limited quantity of it and other people want to buy it at any given time. So I've used gold in and out of portfolios on occasion. I almost put a big chunk of gold in about 6-7 weeks ago, middle of March, but I didn't because the Fed came in and started, backstopping everything with cash. But gold can play a role in the portfolio, but it's not something you want to overinvest in because all things aside, what does it really do? Doesn't do much of anything. Now, historically, not to go down a rabbit hole here, but farmland has actually been a very good investment in times of recessions, and silver is actually a better investment in times of economic collapse. Because in economic collapses, people tend to, the currencies become no good, and people use silver because it's easier to monetize than gold. You're not going to walk around with a gold bar and just shave off a little bit of gold dust to buy a loaf of bread. It's a lot easier to monetize silver. So gold's an interesting part of a balanced portfolio at times. I use it tactically. I don't keep it in there at all times, but it's not something you want to overweight in at all because historically it's a big underperformer from everything else.
Perfect. Thank you.
Yeah, you're welcome. I always tell people this, the world can fall apart and Coca-Cola is still going to sell Coca-Cola. Right. But gold's only going to go up if everybody's trying to buy it. So it can be a part of a portfolio, but not something you want to hang your hat on.
Mm-hmm. Thanks.
No, you're welcome. Any other questions?
I don't see any on the group chat or anything. I want to thank you for working and helping and saying all these positive things people are going to go out with.
Well, yeah, my pleasure. Still, economy is still not without risk, But I do think the market has really told us a few things in regards to the bottom DNN. So I think the worst is probably behind us at the moment, and the key will be how we handle the fall. That's really where we're at. So
yeah.
Good to see you, Cindy.
Yeah, you too.
All right.
Thank you.
Have a good one.
You too.
Bye bye.
Thank you. Bye.
Bye bye.